Surging inflation data has just put the Australian dollar back in the spotlight, and it could force the next big move in both FX markets and central bank policy. But here's where it gets controversial. Is this the start of a sustained AUD rally, or are traders getting ahead of themselves? Australian dollar climbs on hotter CPI. The Australian dollar is extending its winning streak against the US dollar for a fourth straight session, with the Australian dollar to US dollar pair holding firm on Wednesday. This latest push higher comes after the Australian Bureau of Statistics released its first fully updated monthly consumer price index report, showing prices rising 3.8% year-over-year in October. That figure not only beat the market expectation of 3.6%, but also accelerated from the prior 3.5% reading, sending a clear signal that inflation is still running hotter than many had hoped. For traders, this means the AUD is getting support from data that reinforces the idea that inflationary pressures in Australia have not fully cooled. When price growth surprises to the upside like this, markets often assume the central bank may need to stay cautious or even lean more hawkish for longer than previously thought. And this is the part most people miss. Even a small beat in CPI can shift interest rate expectations enough to move a currency meaningfully. RBA policy outlook back in focus. The stronger inflation print adds extra weight to the debate around the Reserve Bank of Australia's next steps. Current expectations suggest the RBA will likely keep its official cash rate at 3.6% at the December meeting, especially with inflation still above the bank's 2 to 3% target range. In other words, the RBA appears caught between elevated inflation on one side and growing concerns about economic momentum on the other. RBA officials have pointed out that the unemployment rate has ticked up only slightly, and they still view the labor market as generally solid. A resilient jobs backdrop gives the central bank some room to keep rates higher for longer if needed, without immediately triggering fears of sharp downturn. However, it also raises a difficult question. How long can the RBA lean on a strong labor market narrative if growth continues to slow beneath the surface? Signals from RBA minutes and market pricing. Minutes from the RBA's November meeting suggest the central bank may be comfortable leaving interest rates unchanged for an extended period, adopting what looks like a more patient, wait-and-see stance. That kind of language usually hints that the bank is not in a rush to either hike or cut, instead allowing incoming data to guide the pace of any future moves. Market pricing, reflected in the ASX 30-day interbank cash rate futures, reinforces this cautious outlook. As of November 25th, the December 2025 contract was trading around 96.41, implying only about a 6% probability of a rate cut from 3.60% to 3.35% at the upcoming RBA meeting. This tiny implied chance of near-term easing underscores how reluctant traders are to fully embrace a dovish RBA narrative while inflation remains sticky. US dollar under pressure as rate cut bets grow. While the Australian dollar is getting a lift from stronger inflation data, the US dollar is facing the opposite dynamic as markets increasingly price in Federal Reserve rate cuts. The US dollar index, a gauge that tracks the greenback against a basket of 6 major currencies, is hovering near 99.80 after modest losses in the previous session. That level reflects a currency struggling to gain traction as sentiment shifts towards earlier and more aggressive Fed easing. Futures-based probabilities captured by tools that track Fed expectations now show markets assigning more than an 84% likelihood that the Federal Reserve will cut its benchmark overnight rate by 25 basis points at the December meeting, up sharply from roughly 50% just a week earlier. For context, such a quick swing in expectations is significant. It means a large share of investors now assumes the hiking cycle is not only over, but may give way to cuts sooner than initially thought. Mixed U.S. data supports a dovish tilt. Recent U.S. economic data has given doves at the Fed more arguments. Producer price index inflation held steady at 2.7% year-over-year in September, matching both consensus forecasts and the August result, suggesting that price pressures in the production pipeline are no longer accelerating. At the same time, the core PPI measure, which strips out more volatile items, eased from 2.9% to 2.6%, slightly below expectations. Consumer data paints a picture of more cautious spending behavior. Retail sales rose just 0.2% month-over-month in September, a clear slowdown from the 0.6% growth recorded in August, hinting that households may be tightening their belts after a period of robust demand. Adding to this, the Conference Board's gauge of consumer confidence dropped sharply in November, sliding to 88.7 from 95.5 in October, which suggests people are feeling less optimistic about the economic outlook and their personal finances. Fed officials lean toward cuts. Comments from key Federal Reserve officials have further reinforced market expectations for a potential near-term rate cut. Fed Governor Christopher Waller recently highlighted his growing worries about the softening labor market, stating that inflation is no longer his primary concern in light of weaker employment trends. He also suggested that the September payroll figures may be revised lower and cautioned that highly concentrated hiring in a few sectors is not a reassuring sign, signaling his openness to cutting rates soon. New York Fed President John Williams added to the dovish tone by remarking that policymakers could still opt for a rate reduction in the near term, which pushed market odds for a December move even higher. Fed Governor Stephen Miron also pointed to non-farm payrolls data as supporting the case for a December cut, noting that if his were the decisive vote, he would choose a 25 basis point reduction. Here's the potentially contentious angle. Are Fed officials at risk of easing too early, or are they wisely moving to protect jobs before the slowdown deepens? Australia's latest PMI readings and RBA stance. On the domestic data front, Australia's latest Purchasing Managers Index figures offered a cautiously positive backdrop. The preliminary S&P Global Manufacturing PMI moved back above the 50 threshold that separates expansion from contraction, rising to 51.6 in November from 49.7 previously. This suggests that factory activity has shifted from mild contraction into modest growth. The services side of the economy also showed incremental improvement, with services PMI ticking up to 52.7 in November from 52.5, while the composite PMI, which blends manufacturing and services, climbed to 52.6 from 52.1. These readings collectively hint at an economy that is still growing, albeit not in a runaway fashion. For the RBA, such figures help justify a more balanced policy stance. Not so weak that cuts are urgent, but not so hot that aggressive rate hikes are necessary. RBA communication and inflation risks. The RBA's November meeting minutes indicated that policymakers have shifted toward a more neutral posture, signaling that they are comfortable keeping the cash rate unchanged for longer if incoming data proves firmer than expected. This reflects an attempt to strike a middle ground, acknowledging inflation risks while also recognizing the need to avoid over-tightening in a fragile global environment. Assistant Governor Sarah Hunter recently emphasized that sustained growth above trend could reignite or intensify inflation pressures. She also underscored that monthly inflation data can be noisy and that the central bank does not intend to overreact to a single data point. Instead, the RBA is keeping a close eye on labor market dynamics to judge how much spare capacity exists in the economy and is carefully evaluating whether the impact of higher interest rates is unfolding differently than in past cycles. The controversial question here is whether this patience is prudent risk management or a potential mistake that could let inflation stay uncomfortably high for too long. Australian dollar to US dollar technical picture, eyeing 0.6500. From a technical analysis perspective, the Australian dollar to US dollar pair is trading near 0.6480 on Wednesday, reflecting a market that has recovered but is still testing key levels. On the daily chart, price action is currently contained within a rectangular consolidation pattern, suggesting a broadly neutral bias while traders wait for a clearer breakout in either direction. Despite the recent advance, the pair continues to trade just below its 9-day exponential moving average, currently around 0.6479, signaling that short-term upward momentum is still somewhat subdued. Immediate support sits near the lower edge of the consolidation zone, around 0.6420, with an additional support reference at the 5-month low near